All right, let's talk about mutual funds. You've probably heard about them, right? They're a super popular way to get started with investing here in India. And let's be real, when you're just starting out, it can all seem, well, pretty confusing.
I mean, you're bombarded with all this jargon. You see thousands of different options, and you're just sitting there thinking, okay, where on earth do I even begin? Trust me, if you're feeling a little overwhelmed by it all, you are definitely not alone. It's a totally normal feeling.
But hey, that's exactly why we're here. We're going to cut through all that noise. The whole point is to break this down, step by step, and give you a really clear, simple roadmap to get started.
Okay, so first things first. How do you actually get your money into a mutual fund? Well, there are basically two main ways to go about it, and you'll want to get familiar with both. We've got the systematic investment plan, which you'll hear called an SIP, and then there's the lump sum investment.
So what's the actual difference? Think of an SIP, a systematic investment plan, as putting your investing on autopilot. It's all about consistency. You invest a set amount of money, like clockwork, maybe every single month. It's fantastic for building that saving habit, and it also does something cool called averaging out your cost, which basically helps smooth out the bumps of a volatile market. Now, a lump sum, that's exactly what it sounds like. It's a one-time, bigger chunk of money. Maybe you got a bonus at work or came into some extra cash, and you want to invest it all at once. That's a lump sum.
All right, but before you rush off and choose between an SIP or a lump sum, hold on. There's a little bit of prep work you've got to do first. You need to ask yourself a few really important questions. Honestly, this is the foundation of smart investing. Knowing your goals, figuring out how you feel about risk, and just understanding the practical side of how to start. So let's start with the biggest question of all. Why are you even doing this? I mean, what's the goal? Are you trying to save up for a big trip? Maybe a down payment on a house? Or are you thinking way down the road, like for retirement? Seriously, your answer here is going to shape every single decision you make from this point on.
And look, these are some of the classic goals, right? Long-term wealth, travel, retirement. Maybe you're just trying to save on taxes. The thing is, each of these goals needs a totally different game plan. A mutual fund that's built for creating wealth over 20 years is going to look very different from one that's designed to give you some extra income right now. You got to know your destination before you can pick the right car to get you there. Makes sense, right?
Okay, next up, risk. And I want you to be really honest with yourself here. Picture this. The market takes a nosedive tomorrow, and your investment is down 10%. What's your gut reaction? Do you freak out and want to sell everything? Or do you kind of get excited, thinking it might be a good time to buy more? There's no right answer, but knowing how you'd react, that's your risk tolerance. And it's absolutely crucial to figure that out because, and this is a big one, the value of your investments will go up and down in the short term.
So you might be wondering, who's actually in charge of all this money? Who's making the decisions? Well, that's where something called an asset management company, or AMC, comes into play. Just think of them as the pros behind the scenes. They're the ones who create the mutual fund in the first place, and they have a whole team of experienced fund managers who decide where to invest your money. Basically, they do all the heavy lifting for you.
Okay, so you've figured out your goals, you've got a handle on your risk tolerance. Now what? How do you actually invest? Well, you've got a few main options. You can go straight to the source and use the AMC's own website. You could go through your bank or another kind of financial distributor. Or, and this is super popular now, you can use one of the many online investment apps and platforms out there. Each one's a little different, so it's really about finding the one that feels right for you.
All right, now that we've covered the how-to, let's get into the good, the bad, and the stuff you just need to be aware of. It's time to weigh the pros and cons. Look, no investment is a magic bullet, and mutual funds are no different. To make a smart choice, you really need to see the full picture, the benefits, and the potential risks.
Let's start with the pros, and there are some really compelling ones. First, you've got those professional fund managers working for you. Second, and this one is huge, is diversification. You've heard the saying, don't put all your eggs in one basket, right? That's exactly what this is. Your money gets spread out across lots of different investments, which helps to lower your risk. On top of that, they're usually pretty liquid, which just means you can get your money out when you need to. And hey, some of them even come with tax benefits, which is always a nice bonus. But maybe the single biggest advantage is just how accessible they are. So many people think you need like a fortune to start investing, but that's just not the case. With a lot of mutual funds, you can get started with as little as 100 rupees. Yeah, just 100. That fact alone makes investing possible for so many more people, and that's a really powerful.
Now, of course, we have to be real and talk about the risks. The number one thing to burn into your brain is this: returns are not guaranteed. The The market goes up, the market goes down, and nobody can predict it with 100% certainty. Another thing is, there are just so many options. We're talking thousands of different funds, and that can be really overwhelming. And finally, you gotta watch out for costs. Every fund charges a small annual fee. It's called an expense ratio, and while it might seem tiny, it can definitely add up and impact your earnings over the long haul.
So, okay, we've gone through a lot, right? The different ways to invest, the homework you need to do, the good stuff, the not so good stuff. So, what's the big takeaway here? If you remember only one thing from all of this, what should it be?
It really all boils down to this. Mutual funds can be an incredible tool for building your wealth. But the secret sauce, it isn't about trying to perfectly time the market or finding some secret magic fund that no one knows about. Nope. The real key is to start small, be consistent with it, and always think long-term. So really, the question isn't just how to invest anymore, it's when are you going to start?